Hi everyone, it's me, Bon, and welcome to my first daily edition. In this daily edition, I'm going to talk about my answers and explanations on my DE4 paperwork. So, there are two parts, exchange rates and interest rates. I'm going to start with exchange rates first. So, imports are the goods that are bought from a different country because they're bought in as an import. Exports is the opposite, which is products from country given or exported to another country for sale, reusage, or basically general raw materials. If the value of the British pound decreases, British exports will be cheaper abroad. This is because since the value of the money of the British pound has decreased, it means that compared to the other currencies, for example the US dollar, Chinese yuan, or Indian rupee, Vietnamese dong, it means that we can buy their product or materials for cheaper for the same quality. Next, which of the following statements best describes what is meant by an exchange rate? So I chose the last one, which is the price in which one currency can be traded for another, which is because the exchange rate here is talking about the exchange rate or percentage in the values of money of different currencies. Next is a Chinese company that makes hats, etc., etc. So for this question, my answer was, if the Indian rupee falls against the Chinese yuan, it means that the Chinese can actually buy more raw materials for less money than they used before, which means that they can generate more profit in the long run. Next, if the value of US currency rises against China's currency, what would happen to their sales, basically? So, theoretically, in my opinion, or maybe as a theory, the Chinese could probably take advantage of this. Since their money is worth less than the US money, they could research the US market in order to find the average hat prices so that they can lower the prices just about a bit lower, but they can still make a huge margin of profit. This is why, or this is the theory that I have, so if the Chinese were to sell their products in America. Next, interest rates. Which of the following groups will benefit most from high interest rates? Which are banks that lend money to businesses, because with higher interest rates, the banks will have more profit and hence will generate more income to pay the employees and be a better business in general, etc. 2. Figure 1 shows how interest rates changed in the country between the 1900s and 2010. So, A, identify which year was the most expensive for borrowing money, which was 1982, and state a reason for your answer to A, which is question B, which the chart just shows, if I count by the pixels, that 1982 was the most expensive year to borrow money. C, explain how the overall trend in interest rates between 1980 and 2010 may have affected consumer spending. In people from 1900 to around 1950 would have really thrived, but from the 1980 period and a little bit forward, around at least 10 years, they wouldn't really have done anything because the interest rates were around 16%, which is a lot, while the usual, or the average from which I calculated, is around 4 or 5, depending on the country. Which is why that for almost 23 years, since 1960s, the inflation was really high or was increasing. So they couldn't really buy or invest much, which it's like a recession. But after 1980, the prices went down again, and so did the inflation. So the general summary of this economy was that they were stabilized. It decreased just a little, rose up by a mountain, went down like a mountain, and then stabilized again. So that's all for my DE4. Have a nice day. Goodbye.